Okay, so from the introduction, you know I'm the co-founder of the Bitcoin Foundation, which launched in 2012. I am also an investor and non-executive board director for several Bitcoin startups in the space, so covering many different industries. And before that, my life was in financial services. So I'm actually a trader, a derivatives trader by training. Foreign exchange trader. So I worked as an interest rate derivatives trader for Sumitomo Bank in Chicago branch, which at the time the Japanese banks were the largest banks in the world. So I'm very excited about crypto derivatives. I'm also the foreign exchange dealer for Visa International, where I built the foreign exchange department to process all those transactions for Visa, the ones that you guys make every day when you go overseas and use your credit card. I was the one who put that rate in your credit card. So you can thank me for that, and it's a really good rate. That's kind of a rigged game because Visa has an unfair advantage in that. We called it legalized theft. So that's my background from the financial world. What I want to talk about today is interest rates for Bitcoin, because Bitcoin does have a LIBOR, and it will start to become more and more important as we see a new capital market formation. But before I talk about that, I want to discuss something that I spend a lot of time talking to the media about and talking to public relations firms. Because we deal with a lot of PR firms that work with my startups. And they all have a hard time getting their head around what are the benefits of Bitcoin? Like, how can I convey the benefits of Bitcoin to a normal person on the street? And it's very, very difficult to do. Unless you are from a certain part of the world where it's painfully obvious, it's going to be a struggle for you to see why Bitcoin has so many benefits, but it really is contextual, and it makes the narrative very, very personal. So it's personal for each and every one of you on why Bitcoin is important. And I'll give you some examples, because if you're from Argentina, Venezuela, Zimbabwe, then one of the personal benefits is going to be that you need to protect your wealth from the incompetence of the monetary issuer. That's going to be a pretty obvious one. So if you're in those parts of the world. If you're not from those parts of the world, then you might not relate to that. Well, the massive inflation that we're going to see at the Fed and ECB will, it'll be multi-generational, so you might not see it all in your lifetime. But in Venezuela, they see it in the period of like 5 years. I actually only think that they have maybe 2 or 3 months left in Venezuela before it spins into hyperinflation. So another contextual benefit would be China. If you live in China, you're subject to capital controls. So the benefit there is you have a way to move capital outside the domestic borders. That's a different benefit than we would see in Western Europe or North America, where we can still, for the most part, freely move capital across borders. Cyprus is another one. If any of you remember, I think it was about 5.5 years ago, when Cyprus started a deposit tax. I went all through university and economics and tax accounting. I never even heard of a deposit tax. So they invented this new deposit levy, where anybody who woke up that morning and had cash in the bank had to pay a deposit levy, and that's what they did in Cyprus. So if you live in Cyprus and you didn't want to pay that deposit levy and you had money in Bitcoin, that was a very positive benefit. But not everybody in the world could have related to that. And then, the last, I saved the best for last. If you're in North America or Western Europe, the benefit is protection from financial surveillance. The financial surveillance that we're seeing is more and more insidious. And it's getting worse, not better. And the reason that it's getting worse is we're seeing the governments try to squeeze the size of cash transactions from 5,000 euro to 2,000 euro. Pretty soon, you won't be allowed to make a cash transaction. So they want everyone to go cashless because they're promoting the cashless utopia. Well, it's not going to be a cashless utopia. It's going to be very, very scary. It'll be a cashless dystopia. So what Bitcoin allows you to do is keep all the attributes that you already have today with your paper cash, and you can keep those same attributes with something like Bitcoin. You have the user-defined privacy, you have minimal traceability, you have irreversibility. These are not new features. These are features that you have with cash in your pocket today. So Bitcoin doesn't create anything that's scary or new about that. It just lets us keep those same attributes that we already have with paper cash, and it allows us protection from this creeping financial surveillance. That's a totally different benefit than somebody in Venezuela. But let me take it back to Venezuela for a second and share a story with you, because imagine that you're a family, regular working class family in Venezuela. You've saved up, over 20 years, you've saved up some money in the Bolivar. You have a house, you have a car, you have some other things that you're proud of over the years, and you thought you had a good retirement. Well, in Venezuela, what's happening is they have to keep adding more zeros to their currency. So they have to have 100,000 Bolivar notes, 500,000 Bolivar notes, 1 million Bolivar notes. And this cannot continue. They can't even, the goods are being wiped off the shelves. They have to go to Colombia for food. They cannot even afford toilet paper in Venezuela. So this is how bad it's getting. And I really feel for the citizens over there, because it's not their fault. They weren't educated in monetary economics. They trusted their central bank issuer, and this is what they get. So here's what happened with the government is they had to print some new money. So they put an order in with the currency printer, and the currency printers are people like Thomas de La Rue, who works in, they're in the UK. They print a lot of these banknotes for different companies. You just have to give them the order, you tell them what you want on the banknote, and then they'll print it for you. So with Venezuela, they printed, they put a big order in with the currency printer in the UK, and because they wanted like 1 million, boxes and boxes of 1 million Bolivar notes. And the order was late in coming. So they were waiting and waiting, and when are we going to get this currency? And so they called up the printer in the UK, and they said, well, we put this order in for our currency, and we haven't seen it. I mean, it's been like 4 or 6 weeks. What's going on? And the printer, the currency printer on the other side of the phone said, well, we cannot send you the money because you haven't paid for it yet. So then Venezuela said, well, if you send us the money, then we can pay for it. And the currency printer said, well, we don't want that money. We want real money. So the point of the story is that the world is going to be going towards hard currency or cryptocurrency, hopefully Bitcoin, where even the currency printers who are printing the funny money are going to want Bitcoin. And that's life in Venezuela. Okay, so the title of the talk is Bitcoin and interest rates, Bitcoin and Ethereum interest rates. The reason I want to focus on that is because along with everything that we're seeing in the ICO market, I agree with a number of the prior speakers where I do think that utility tokens are where the true innovation lies in ICO markets. Because just because something's tokenized doesn't necessarily mean that it's a digital bearer instrument. So the innovation is going to be around digital bearer instruments that happen to be tokens. It's not just around tokenization for tokenization's sake. But interest rates are going to be very, very important because every economy runs on interest rates. The borrowing and lending of interest rates, this is banks' main function before they started getting involved in AML compliance as their main business. They used to just do borrowing and lending and arrange and match borrowers and lenders and come up with a a market-based interest rate that would justify the risk of the loan. This is core banking business, and we're going to get back to that core banking business with cryptocurrencies. You have to. The interest rate is simply the price of money. And the reason you need a price of money in an economy is because you have to have normal borrowing and lending in an economy for an economy to grow. So we're not talking about just Bitcoin being a commodity on its own, where it's just a single alternative asset class that you get into and out of, and you still measure your success in fiat. I don't think that that's going to be the benchmark. The winners in the new crypto economy are not even going to measure their success in fiat terms. They're going to measure their success in cryptocurrency terms, in one of the main crypto monetary tokens. So that's why interest rates are very, very important. And they will drive this future crypto economy, because there'll be lenders, there'll be borrowers, there already are. So I've been proposing and advocating for a reference rate for Bitcoin for a number of years now, but we're getting more and more data points that feed into it that make it possible. So Bitcoin's LIBOR is actually called BIBOR. It's a Bitcoin Interbroker Offered Rate. And Bitcoin's BIBOR right now, on an annual basis, is somewhere between 28 and 48% annually. So given volatility, various other factors, that's what the interest rate is for Bitcoin. So you might think, wow, that's great. I mean, I can be a lender. I can make more than I can make with even Greek bonds. But that comes with, it currently comes with some counterparty risk. It comes with a lot of other risks that you normally wouldn't associate with a typical bond investment. So 28 to 48%. It's been as high as 700% on an annual basis during market periods of stress. And those market periods are when you see spikes in Bitcoin, where everybody wants to all of a sudden short. And to short the market for Bitcoin, you have to borrow it. So what do? You go to this two-way market that already exists for lending and borrowing Bitcoin. And if there's a lot of people that want to borrow it, and there's a lot of people that want to short, then that spikes up the interest rate. So nobody sits there for a year and pays 700% interest annually. That would be crazy. They're doing it on overnight basis. So you can afford to do it on an overnight basis. And the rates I'm talking about are compounded and annualized. The market is still not mature enough to even trade it that way. So the market with Bitcoin and Ether interest rates is still quoted in overnight terms, possibly 1 week money, 1 month money, but no longer than 1 month money, because nobody's willing to do a contract for that. They'll keep rolling it over on an overnight basis, and that's how we know the annualized rates. But let me tell you some of the data points that are going into it, because this is changing every single month, every single week. We have new information. So the reference rate for Bitcoin and to some degree Ether interest rates will be an aggregate and a compilation of the rates that we see out in the market. And there's three sources for that. There will become three sources for that. The first are these exchanges where you can go to borrow Bitcoin for shorting. So bfxdata.com is the window into the Bitfinex exchange for borrowing and lending in Bitcoin. And that's where most of the data comes from. But there's other exchanges that allow you to trade on margin, and they also have two-way exchange rates. Or not two-way exchange rates, two-way market for interest rates where you can borrow and lend. So you can pull that into it as well. So this is a global reference rate. The other area is in the P2P loan business. There's at least 4 Bitcoin or crypto startups, more than 4 if you count a lot of the new tokens, but at least 4 that are dealing specifically in Bitcoin peer-to-peer lending. So those operations are offering 20% a year to lend out your Bitcoin for a series of microloans or responding to the market pressures, market demand for peer-to-peer lending. So that's another data point that we have coming in to the index is the entire market for peer-to-peer loans. An example of that is a company in Germany called Bitbond. Bitbond does a really good job on the P2P market, for a P2P lending market. But now we have something even newer, because we're seeing the scaling debate for Bitcoin play out in the real world between Bitcoin and Bitcoin Cash. So prior to the August 1st fork with Bitcoin Cash, the scaling debate was behind the scenes. The scaling debate was in forums. The scaling debate was in developer chat rooms. It was on GitHub. So it didn't really get out and break out into the market until August 1st, when Bitcoin Cash felt that they had no other recourse to persuade anybody or affect any change in the direction of the protocol. So they went with their own scaling solution, which is heading towards basically unlimited block sizes, and that became Bitcoin Cash. So now we have two different approaches to the scaling: Bitcoin Core and Bitcoin Cash. And the market, we don't know which one's going to win. We honestly do not know. People are firm on their convictions, they're firm on their opinions, but it's still an experiment, and we're still trying out new things. The hash rate will be a very important indicator of which approach to scaling we feel is going to prevail. And if you follow the hash rate, Bitcoin Cash hash rate on SHA-2 hashing is 15% of the Bitcoin original hash rate. So hash rate follows money. So the price, coincidentally, is also 15% of Bitcoin Core. So the Bitcoin Cash rate is 15% of Bitcoin Core. Now, if you wanted to see who was going to win in the scaling debate, at least in the universe of market opinion, it's going to be the investors that start steering more money into which solution they think is going to win. So right now, the odds are approximately like 8-1 in favor of Bitcoin Core being the scaling solution that's going to prevail in this. So this is a key for you to see if money starts pouring into Bitcoin Cash. And I watch that ratio very carefully. It's about 13 to 15%. The price of Bitcoin Cash to Bitcoin. If that starts turning to be 20%, 25%, then you know that a significant amount of money is going into Bitcoin Cash, most likely because they see it as a bet on who's going to prevail in the scaling solution. But that new price for Bitcoin Cash will then be reflected in the hashing rate, because the miners will steer their computational power towards mining for Bitcoin Cash. And you can do this because SHA-2 mining is a zero-sum game. It's not like, if you have to either be mining on something that's a SHA-2 consensus-based currency or not SHA-2. It's all going to add up to the same amount. So right now it's like 8-1. So where I was going with that, I kind of lost my train of thought, but where I was going with that is the Lightning Network is being introduced for Bitcoin Core. You're seeing more and more transactions going on the Lightning Network. The network is growing. It's looking quite promising, actually. The fact that the Lightning Network is able to accommodate all these transactions that are off the main chain. They're protected, and they can eventually go on and settle on the main chain, but they're currently off the main chain. Now, what does that have to do with interest rates? Why am I bringing that up? Well, people are starting to realize that the Lightning Network operates like a collateral network. So you have to tie up your Bitcoin on the Lightning Network to actually use Bitcoin. So that means you have to take 10 Bitcoin from somewhere and hold that in the Lightning Network, which is off-chain, to allow another 10 Bitcoin to be used on the Lightning Network. That's a simplified version of it. But because it's collateralized, and because it's shifting so many transactions from on-chain to off-chain, is that collateralization the collateralization of that payment channel, that other network that's off-chain to Bitcoin, is going to have a two-way market for interest rates. Because people are going to need to borrow and lend against, to be able to have money on those Bitcoin Lightning Network nodes. So it's a profit-making enterprise to run a Lightning node, and you're going to be compensated for that. So the interest rate will be very important, and that'll be, coincidentally, that'll be a third data point for where we can get more data for the Bitcoin LIBOR, for the BIBOR, is you're going to have an interest rate market that develops around Lightning. So very, very important. It's going to be it's going to be more like a risk-free return on capital. So it'll be lower than the other interest rates. So it'll operate like the risk-free interest rate, like the way people think of U.S. Treasury bills or something. Because your money's not that much at risk if it's on the Lightning Network, but it still has a cost because it's being used as collateral. So another data point. Now, Ether also has an interest rate because people want to buy and sell Ether. Now, the interest rate for Ether is roughly only half of the interest rate for Bitcoin right now. I'm not sure why. I just know that if you look at the stats in the market, it's trading at roughly half of what Bitcoin's interest rate is. It hasn't been around for as long, so there's not as much of a history on Ether interest rates. But because a lot of people in the market think of Ether as, even Ethereum Foundation says don't think of it this way, but people think of it as a store of value. So they'll park money in Ether, and the more volume that you have, the more trading that you have, then the more shorting that you have. So it's going to open up a two-way market for the interest rates, and that's what we're seeing because of the ICO market. We're seeing this class, a class of tokens that operate as almost like gateway tokens to the rest of the token world. So we have the main store of value crypto tokens, which ironically, if you asked me, in 2011 when I was talking in the other building at the gaming conference, I would never be saying, well, Bitcoin is the safe conservative investment. If you want to be safe and conservative, then park your money in Bitcoin. People would think I was crazy back then. But now that's exactly what's happening. People are looking at Bitcoin as the safe investment. It's the store of value that underpins a lot of the other activity in the crypto economy. The crypto tokens, when they raise money, when these ICOs raise money in Ether and Bitcoin, they raise a majority of it in Ether, but they tend to keep it as a store of value in Ether and also in Bitcoin. So these currencies become a store of value. And those crypto monetary tokens will be the primary gateway tokens to the rest of the crypto economy. And we're seeing that evolve right now. Okay, so that's my spiel on interest rates. I want to talk a little bit also about how I think this is going to impact monetary policy and fiscal policy for governments mainly. And that's because I'm an econ geek, so I'm going to talk about it. Bitcoin is directly competing with central bank fiat currency. It's not competing with banks. Banks are the good guys. Banks only became the bad guys when they started to be a surrogate enforcement force for the central banks, who made the banks do all their AML dirty work. But banks are in the business of making a market in foreign exchange, making a market for borrowing and lending. So Bitcoin doesn't really compete against banks. Banks have an opportunity to embrace Bitcoin. Commercial banking should embrace Bitcoin as just another 3-digit currency code, another ISO code, like the EUR, the GBP, the USD, and now XBT for Bitcoin. But it's the central banks that need to be worried about Bitcoin, because it's a direct threat to their to their ability to issue fiat currency that is only backed by the state's power, where the state gives it the legitimacy to be money. So they should be frightened by that. Money is an illusion. The central banks just want it to be their illusion from the top down. People who support Bitcoin want it to be a grassroots illusion where we can reject the authorities' illusion and we can have our own illusion from the bottom up. This is why it's so important and imperative for people around the world to embrace Bitcoin and to get involved in Bitcoin, because it's this illusion. We're not kidding ourselves. We know money is an illusion, but we're saying let's have it be our illusion from the bottom up and reject the authoritarian illusion. And that's going to have impact on monetary policy and fiscal policy. So I'll start with the monetary policy. On the monetary policy, fortunately, Simon Dixon already talked about it a little bit, but we may be seeing the end of fractional reserve banking. And we're not sure yet if we'll see the end of fractional reserve banking, but until we know whether Bitcoin can have money substitutes, we won't have the need for fractional reserve banking and the lender of last resort. So there won't be this notion of lender of last resort. And that is a very positive development, in my opinion, an end to fraudulent fractional reserve banking. We may have fractional reserve banking with Bitcoin, but it will be in an honest way where people who are circulating and trading in those instruments will know that it's only backed by a certain amount of Bitcoin, 40%, 50%. And those ratios will be very well known because that's information you can put on the public blockchain. So fractional reserve banking by itself is not fraudulent. It can evolve in a free market, but it won't be state-sanctioned, state-controlled, state-manipulated fractional reserve banking. And the other thing that we'll see a change in on monetary policy is the interest rates. With the Bitcoin economy, we won't see open market operations. We won't see central bank interest rate manipulation of the interest rate curve, because they won't be doing their buys and sells, from that secret floor in New York where they manage the interest rates. The interest rates will be determined more by what I mentioned before, which is the regular market demand, supply and demand of the riskiness of the venture, which is what it should be determined by. Interest rates aren't evil. It's the price of money. Interest rates are only evil when they're manipulated by the issuer for the issuer's own advantage. And Bitcoin will not allow that, because what will happen to central banks ultimately in a Bitcoin economy is they will end up like all these central banks in Europe and Eastern Europe that have adopted the euro. They have these big buildings where their old central banks used to be, but they're all empty. Now they're really AML enforcement buildings now. That's all they do in these old central banks. Okay, but that's not even as interesting as what's going to happen on the fiscal policy side. Because on the fiscal policy side, we're going to see changes that you can't believe. We're not going to see an end to taxation. So don't start thinking that, oh my God, with Bitcoin, there's an end of taxation and everybody's going to be happy and there's no more taxes. Well, that probably isn't going to happen. But I think that what will happen is we're going to see a change in the type of taxation and a change in the way that governments finance themselves. So governments are heavily reliant on income tax right now. I see that starting to shift because as more and more people either work in the consultant economy or in the freelance economy or multi-jurisdictional, non-jurisdictional companies, it's going to be more and more difficult for the tax authorities to ascertain true income. So your income reporting for almost everyone will start to be like income reporting for waiters and waitresses in the U.S., where they report what they feel like reporting. It's an honor system. If you're a bartender in the U.S., your reporting of tips is on the honor system. So governments cannot last long if everybody is reporting their income on the honor system. So for their own survival, what they will do is they will most likely migrate to consumption-based taxation. So we'll see higher consumption taxes, either lower or elimination of the income tax, and VAT is going up. And in countries like the US where they don't have a VAT, we'll see a VAT. But that will make up for the income taxation going down. That means we're going to be moving, most likely, from a progressive taxation to a regressive taxation, which in my opinion is a good thing, because the progressive taxation is it's one of the fundamental tenets of Marxism. So we have to get rid of progressive taxation. After taxes, the next positive benefit that you'll see on the fiscal policy side is you will see a government that can only raise money by getting it from the electorate or from its citizens. So there will be no more deficit spending, no more deficit financing, no more wars that you fund, not because the people wanted the war, but just because you have the reins of the central bank and you can finance it later. So this is why people like Roger Ver say that Bitcoin will lead to an end of war. He's halfway right, because it will lead to an end of deficit spending for war, which is what most wars are. In the future, if a government wants to embark on a very expensive endeavor, whether it's militaristic or not, it could just be going into space, they're going to have to justify that. They're going to have to justify that by getting that revenue up front through taxation, any form of taxation. They won't be able to just use the central bank as a way to fund it. So that's what's on the horizon for Bitcoin. And to a certain degree, it's also for the other monetary crypto tokens. But right now, Bitcoin is the de facto leader in that space, and you have to watch the computational hash rate. We're operating at exahashes per second right now. I think that proof of stake will prove to be a complete failure. I'd be very bearish on Ethereum if they migrate to proof of stake. It's never been tried before on a cryptocurrency that is that size of a market cap. I don't even think it would stay at proof of stake. I think it would eventually devolve into another form of proof of work. But that's what you need to watch, is the hash rate, the computational power of the network. It's unfortunate that we do use as much electricity as it takes to power the country of Denmark. But, it's like that MasterCard ad that we see where, how much is it really worth? Censorship resistant, government proof peer-to-peer money. Well, it's priceless. I don't like the fact that it costs that much to run it, but that's what it costs. Otherwise, it wouldn't even be around. So because of that, and because Bitcoin's resilient, it needs that much power. And the exahashes, by the way, is very, very near the end of the metric system. If you look at the metric table, pull it up on Wikipedia, there's only 2 prefixes after exa before we're off the metric table. I think it's Zata and Zeta. There's 2 more after exa. And somebody's going to have to invent another prefix on the metric table. And that will make the scientist who invents that very famous. So thank you for listening. I enjoyed it. And let me know if you have any questions.
There we go.
All right.
John, you used to give a stat, which I used to love, on the 500 largest computers, and then Bitcoin was 5,000 times larger than the sum of the 500 largest. Have you updated that stat recently?
Well, it's still the same. I mean, you can't really measure. It's not a one-to-one comparison of SHA-2 hashing and flops, but it's close enough. It approximates it. So the stat that Simon's referring to is that the combined consolidated computational power of the Bitcoin network, at 17 exahashes per second, is larger than the top 500 supercomputers in the world combined. And it didn't always used to be that way. In 2013 is when it passed. And in 2013, before 2013, the largest distributed computer project on the planet was SETI, the Search for Extraterrestrial Intelligence. So people have realized that it's a lot more fun and productive to mine for cryptocurrency than to search for silly aliens in outer space.
Hi, John.
Yes.
You started your talk with a metaphor from Visa and ended it with one from MasterCard. Priceless. I'm just going back to the part on interest rates and obviously the interest rate-based derivatives that we could possibly have then on Bitcoin and other oil coins. I think one of the key interest rate components is the time for which the interest rate benchmark is used, LIBOR or BIBOR in this case. And it seems the application right now is short-term lending for covering shorts. Mm-hmm. But when you're looking at a longer yield curve and you've got borrowings for years and onwards, like for the government's financing of their own deficits, how long do you think before we evolve to a market where there's a longer yield curve on Bitcoin?
Yeah, you're right that it's very short term now, and we're only getting annual rates because we annualize them. We take overnight money, 1 week money, and we can annualize it. So we're not going to see true 1 year money rates until people are willing to sign loans in that amount and make loans in that amount. It would be foolish to now because of the volatility, I think. So once we start seeing the volume of commerce going through the blockchain, once we start seeing that volume of commerce, then I think we'll eventually see reduced volatility. And when we get to that point, even though it could be upward sloping volatility, at least it won't be the kind of volatility that we're seeing now. It's more likely to go further and further out on that interest rate curve. But the key thing is nobody's making that. It's not like a demand from the central bank that we have to have 1 year money. It's evolving in the market. And the way it's evolved is overnight money, 1 week money, 1 month money. We'll see where that takes us. Personally, I think it's probably about 3 to 5 years off for even thinking about 1 year lending. So we have to compound it until we get there. Yes? Stable, just repeat it.
Yeah, how do you envisage a stable lending economy with a fixed currency supply?
I think it's already been compensated for and accounted for by the 8 decimal spaces to the right of the decimal point. If you follow that out, there's enough room for at least significant growth in what we could even project the economy size to be in the year 2050. So, don't get caught up in this thing that everybody has to own 1 Bitcoin. There's not even enough Bitcoin for everybody in Spain to own 1 Bitcoin.
You're talking about the value of the currency.
You're talking about how you can subdivide it. Well, with 8 decimal places, you can.
You're talking about the value split,
Oh,
stability of the value.
well, you have to unlearn all your Keynesian economics that you learned in university and tilt your head and let it drain out, because deflation is your friend. Deflation increases your purchasing power. It's a Keynesian misnomer that you have to have inflation to keep an economy going. It only benefits the issuer of the currency. Well, that wasn't a true gold standard, and it's another Keynesian argument that I don't want to get into on the stage right now. But it's all part of the same thing. It wasn't a true gold standard. What's that? Yeah, sure. You're welcome to buy me a beer. All right. Thanks a lot, you guys.
Thank you very much.